Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today's agenda, I'll go through the market update. Earnings season has just begun with a bunch of the pre-runner trades. So we have a few of those out and we'll review those. And then Joe's going to go through some charts. So, and on a administrative note, Joe and I were traveling, so, appreciate people flexing. We had to move to like a Tuesday, and we should, at least for the foreseeable future, just be back to our regular Wednesday at 1. So, we'll try and give you heads up if anything, changes, but we should be good for a while, at least based off our schedule. So thank you. And, you can always go to, if you miss meetings, I'll just pull that up real quick. Our Delphian YouTube channel. So I changed it a little bit. So all the weekly meetings are, at the top here on the homepage, just make it easier. And then you got the popular ones. You go into the videos, there's like a ton of them. There's 212. So all the latest ones will be shown here. So, okay, let's get into the market. So I think last week, we had talked about short term, with seeing a bounce. So we saw that bounce. It was short. The past couple of days of it, today included, things have turned around a little bit, but overall green pie, we went from 21 to 37 from a week ago. So it's definitely, we got the bounce we had thought. We're technically, when we're above 30% in the green, we're no longer oversold. So, this was oversold. So below 30 is oversold.
I guess I will text you. I just spoke to.
And there's a mute. Okay. So below 30 is oversold. So now, we're technically no longer oversold, kind of chop range. So crazy little spread here on, the states. You got NASDAQ in 1, Russell in 8, and SPX in 5. Just very strange markets, not very correlated. If it, just looking at those kind of numbers. So this kind of par for the course. With the markets we've been dealing with for, over a year, just kind of here or there, all over the place. The rates have definitely, that's a big mover too. Recently, big drops in those rates. So we'll get into all that. So let's look at the market pulse first. So it's going to just kind of show. So last week, we were pretty much flatlining right around here. So we basically surmised we'd get like a run up. So we did get, a nice run up there. It's turned around, obviously, yesterday, and, today's looking down a little bit, at least for SPX. So, most of the time when you go through these, it's just like kind of gravity. These things, want to get to at least near or, cross or, get real close to it. This one's like, a few percentage off from crossing, but when it turned, but a lot of the time when these things do roll over, they do cross. So we're kind of like in that no man's land. So I just kind of pulled back to see like the last time, we got like a pretty good downward movement, but not across, right away. So that'd be back here. This is, January, February 22. So like, this one, you got the cross, that was it. And it turned right back. But this one, we had a nice drop down into, you can see the bullish got around like 37, 38. It's kind of pretty much right where we are. And then we got a bump up. Market from here, did turn lower, not a whole significant amount lower, but kind of like, did grind lower, after this kind of pop here. So It's possible most of the time, the inertia kind of carries it through for like at least you can kind of bank on that crop getting near that 50-50 at least. So this may be one of those times where it doesn't do it right away, kind of like this. It kind of feels like it. We may get something like this here, but eventually it will, kind of cross there. It took a lot longer than the normal. It's like, okay, it turned over and we get here, or it turns over and boom, a lot of these, that's kind of how we look at it a lot of the time, is these turnover, and then we'll get that cross, and then see how far we go on the other way up. I mean, so this may be one of those times. So I think we got our good signal here, for like a short run up. I think from here, we just got to watch our levels, on our key indexes to kind of, guide us to see if, we get, a big U-turn, or, if it's just kind of going a little, just a lot of chop, but it's still grinding higher. So I think we'll just look at the two indices, to kind of guide us here. So, this, like I said, SPX 5, Russell's still in 8, NASDAQ in 1. So, very strange. So, we had 8. That was pretty much the bottom, like right near. So the bottom, short-term bottom was on the 13th, and I went into 8, and just been going up since. As far as SPX, we had a 1 day in state 6, and now we're in 5. So, when I look at these states that come up, I like to see them follow our typical pattern, right? So then you can kind of bank on it, if it starts following the pattern, getting up in the first level resistance, coming back, finding support. So that's the key part right now. I think we're at, in between the entry and, target 1. I think we were 40-70 around there last time I checked. So really want to see that 40-50 level providing, good support here, and then you would get another run up. Typically, if it follows the typical pattern, which this one is like textbook right now, so that's what I'd be looking for. Key is that, 40-50, right around that area. If it gets down there, finding support, or even a little above it. So it doesn't break that, close below that. I think that would be a good sign within the next few days, if it doesn't break below there, that we can get a run up, back up. And then, from there, the top end, it's going to be difficult. Our range on the big chart is, 4,200 to 38. So, the 42 is going to be pretty tough to break, I think. It's had problems, and we'll show that in the big chart. So, still pretty much like a range bound for the ones we've been talking about for a long time, but you can kind of gauge the action based off of this modeling here. So let's pull up the big chart. So that's the last time it sniffed the 4,200, 41.95. So I would expect that to be a tough break. And we had the false breakout back here. Russell had a similar one, and Russell broke out of its range, but they're still pretty much holding. So they both had like false breakouts. So that's 42 top end, and the bottom is at 38. So it's spent some time below there, but recently it's had really good support down there and good resistance here. So still in the channel. I think some of the things that could move the market, we got earnings starting to come out, I think next week. I think the banks start, I think next like Wednesday, Thursday. So, obviously earnings can move the market a lot, and not so much like, okay, their EPS, but, what's their forward guidance, and, people are going to be looking at, especially for those banks, they're going to be doing deep dives on their statements to see, what their, um, what their holdings are, the amount of losses they have on the balance sheets and stuff like that. So, um, you know, I think that's it for, SPX. Russell, still an 8, from last time we talked. We did have that run up, very short term and, turn back. So, similar type situation. Obviously, the entry price staying above that's going to be critical, but really it's at, it's our 17 to 19 on here. 17's been really good support. It got below on this date here. I think that was the last time. So in a long time. So got 1689 and just like rocketed up from there. So now we're, got up to the middle of the range, and we're drifting back down. I think right around that's 1740. So same type of thing for Russell here. Sorry, wrong one. The 1700 huge level, and see what happens as far as the obviously it's not following any kind of typical pattern in the state 8 right now, so kind of all bets are off on that. But as long as it stays above, I think that entry price, and especially above 1700, then I don't see it, the market really rolling over a ton. If it does break 17, like I said before, like all bets are off. If it can sustain a breakthrough 1700. Okay, let's pull up big chart. Let me clear that. All right. Man, some reason X wonky. All right, so we'll pull this back right about there. Put in our lines. So this is our 19, 2 breakouts above, 17, and it's like 2 breakouts below. Very balanced. Obviously these breakouts were, a lot higher than these kind of minor ones down here. But pretty much same story as SPX. As long as these levels hold the 1700, so we're getting close to that. We're 40 points off of that. As long as that holds, range bound. If earnings really come in as surprise, we can definitely, to the upside. We could definitely run higher. I would just, let me this one's okay. I got muted. Yeah, so still in the range. Just watch at 1700. It's like broken record here. Nasdaq, don't normally look at this, but it's in state 1. Obviously, had a good start. So see if it follows that typical pattern kind of up here. Support and run. So obviously had a good start. I think down a little today. So this one, it's a good sign that it's in state 1. We only get these kind of, if I pull back down to, it's been a long time, right? For let's go back. We only get these type of moves in state 1. So it's a good sign that at least triggered in the 1, these big movements. So the last time I got into state 1 was 2021. So at least that's a good sign that it's in a 1. So but Russell's an 8. Go figure. So we'll just have to watch that, see if it can stay above that entry price. see if we can get the typical pattern out of here. But just wanted to show that kind of real quick. Okay, it's going to pull up 10-year. No, oops, sorry, wrong one. I mean, this one, the volatility continues. This thing's just crazy. I mean, we were up, that's a month ago, we were at 4, like over 4%, and now we're at 3.28. That 3.5 is kind of like the, if you just pull it back some, that like 3.5 is kind of like the magnet recently. So it's well below there right now, which is a little unusual for it to drop that much. Hadn't been that low since, going back here, like August. So, volatility is continuing in this stuff. And, it kind of goes into where the Fed, and we covered this a lot, where the Fed's going with their rates. So we went through and showed, like, I think it was like December, how much things have changed. This is like, 1 month, to current, and, now they're pricing in, that's like 4 to 3.75. So that's, a full percent drop from where we are. So that's a bunch of cuts, whereas, a month ago, they were pretty much calling it stable, from what they expected the last hike. So the expectation now is for cuts. The next one is May. So we're a month out from this, but it's been trending more and more towards no rate hikes. You can see here, like a month ago, it was between 1/4 and 50. So now it's, 1/4 and nothing, with nothing, no hikes being the majority opinion right now. Obviously, a lot of things can happen, and between now and, a month, but, people are pricing in a bunch of cuts. So, if they're wrong,
this is a very, very interesting forecast, because I watched the press release, Jerome Powell's press release right after the last meeting, and someone asked him, they said, the Fed futures are predicting a rate cut, and he said very directly, we don't see any rate cuts coming this year.
Right. And they've
been
saying, yeah,
for this forecast to be right, that the only way the Fed reverses their position is something really bad happens, like a Lehman Brothers event. And so what this forecast is implying is somebody knows there's something really bad out there that's going to hit, most likely in the banking sector.
Right.
It's the only way this forecast can be right.
Right.
Yeah, this is Dave. I think so. You're right there. With the exception that the other reason it might work out is that people just don't believe the Fed. And I think that's happened several times. Oh, we just don't believe the Fed. We don't believe the Fed's going to do this. And then the Fed does that, and it is not bad. It's not good for a short period of time. Then
that's true, but I think Powell has said exactly what he's going to do, and they've done it. And I think
exactly what they said. I totally agree with you, my friend.
The
totally
Silicon Valley Bank problem, where they bought all this long duration
garbage
and said they were surprised by the interest rate hikes. Well, Powell was talking interest rate hikes 6 months before he actually did it, way back in 2021.
Right.
Because of inflation. He gave plenty of warning. I don't know what surprise this was. I mean, we're all just retail people, right? And we knew it was coming here on this call. So yeah, they don't want to believe him. He's done exactly what he said he's going to do for the last 2 years. So I don't know.
Yeah, I agree. I mean, I would take him on his word if they're not going to, at least right now, they're not planning to cut rates, for the rest of the year. I'd take him on his word, unless something happens.
Yeah, the only way this forecast is right, where you have, would you say, 4 or 5 rate cuts by the end of the year?
Yeah,
The only way is if the Fed is forced to reverse their position based on some really bad event. Like,
yeah,
the only two I can think of is there's another bank out there that's about to fail, or they don't resolve the debt crisis, the debt ceiling thing.
yeah.
We had
Go ahead.
It
we
would
had a
be-
very similar.
Sorry.
I was-
It would be interesting. Sorry. Go ahead, Sudhir, go ahead.
All right, Dave, go
Go ahead,
first.
Dave.
Sorry for that. I apologize. But it would be interesting to see this chart, the week after the Fed makes an announcement and the weeks before the Fed makes an announcement. I think there'd be a drastic different looking. They'd look a lot different, and I tend to think maybe the people that supply input to this particular chart, I don't know who exactly they are, but
Yeah.
in my opinion, I think they may be trying to influence what the Fed is going to say, and then the Fed just says what they're going to say, based just upon what we just heard from everybody contributing. So that's why I tend to not look at this chart till like a week or 2 weeks before the next Fed meeting, and then it's like, okay, now it's a lot more accurate to what really happens. So that's my take on this chart and its value between the time that it comes out and whenever the next Fed meeting is.
Yeah. Well, Dave, I made that comment last week. I'm like, well, I'm sure there's a bunch of bankers on here, like, just like hoping that this is the case so that their, unrealized losses shrink. So,
Yeah, sorry, I missed last week. I signed in Wednesday and missed it was on Tuesday, so my
yeah.
bad.
Go ahead, Joe. You had something?
No, I was just going to say, we had a similar market dislocation last August and September. The Fed consistently said they're raising rates, yet rates continued to go down. And, then ultimately the market corrected, in pursuit of the direction the Fed, has maintained. So it'll be interesting to see.
Yeah. I agree. Good discussion. So, we'll keep our eye on this. This is a great tool, and we owe it all to Sudhir who found this one. So, balance sheet, obviously we talked about the huge spike here, but I guess they're continuing the runoff from this wash everything out from October to March, and basically we're back to October levels. So just a slow grind lower. I think M2 is shrinking, so I think that'll help, as far as inflation. Obviously, any kind of oil shock's not going to help inflation at all, because that just, has cascading effects throughout the economy. So, oil's obviously one to watch, but, if they're shrinking the money supply, that is good, as far as inflation, and we've shown charts on that, a bunch in the past. So, I guess the other one, the rates, so the curves, kind of coming down. The twos dropped quite a bit. So the 10's at 3.3, and then the 2 is, about 0.5 away. We got up over 1% difference. So, it's like the curve's kind of moving this way overall, but everything's dropped, with, recently, with the 10-year, basically going from, that's an autoplay, from 4 down, pretty much, 70 basis point drop in a very short period of time. So, this I think is more telling of, market forces. If they're saying, what's in that 10-year, I think is more important than, this like Fed tool, but, both of them kind of give you a good picture of everything. So, Uh, yeah, I think banks are gonna be a problem. And, I'm gonna try and find some time to do a little more deep diving into their financial statements to look at unrealized losses. I talked about Bank of America. I really wonder what like someone like Deutsche Bank, how bad it is over there. If they had bought some negative ones, for 10 years, like, yeah, it's it's got to be real bad. I saw something about like a Swiss pension fund lost like 2 billion or something. Guy got fired, but Credit Suisse, that's a huge one. So, we're just gonna have to see how Europe holds up. We showed charts of their banks. They haven't recovered, since '08 basically. So I can't imagine they're in good shape at all. And then obviously ours, we have idiots out there managing their the bond portfolios that, didn't hedge inflation or never thought rates would, it's just like '08, like housing prices never go down, same type of thing for the, some of these banks. So we'll just have to watch the banking sector closely and, keep an eye on things like Schwab too. This one's taking a beating. So I'm gonna have to look into their financials. So, but I think a lot of the people are moving into like money market type funds, like pulling their stuff out of some of these kind of smaller, riskier banks or big banks, and just kind of moving into like money market funds where they're getting better returns. I would think a lot of people are doing that instead of a lot of these banks, they don't pay anything on their checking savings. So usually in the past they would kind of give you something, but nowadays it's just most of them are giving you nothing. So I would suspect that people that have large amounts of cash just parked there would be like, why am I earning 0.1% when I can go into like a money market and get 3, 5 or something like that. So the banks may see some more. I know there's been a lot of funds moving out of banks, so that could really exacerbate their problems. If they have to liquidate some of those positions, it's just it'll get real ugly for those banks. So okay, I think that was it. I'll open up to questions, comments. I didn't have any good charts. We were up in New York, so I didn't have time. I mean, I've been looking on Twitter, but I didn't see anything good. So I'm sure next week something will pop up.
Yeah, you mentioned big banks, and there's a difference between the big banks and the small banks. And Jamie Dimon usually he came out with some an interesting point of view. I guess I read a couple days ago, which was not really good. But he did that last quarter too, just before JPM earnings. By the way, those are like next Thursday, I think. So next week we should know a lot more than we know now. But JPM stock went up even after he gave his past quarters kind of like what he was thinking before the earnings came out. So it'll be interesting to see how that plays out this quarter. I mean, the bigger banks took I think I looked at a few of them. They're about 15% down after the the Silicon Valley Bank thing came out.
Mhm.
And then the regional banks were down like, I don't know, 78, a lot more. So it'll be interesting to see how those play out this time. Earnings are what drive a lot of the buy and holding investing, and why I think you're right on with a lot of people moving into fixed rate and debt and treasuries and stuff like that. So we're starting this particular earnings season with the SPX, I think, being run up to where it is now for a few months, for a little time before. So that'll be interesting too, to see if it's if the the runners work out really well. There was a big drop before earnings come out, and this time it's SPX is kind of like a fair amount higher before earnings are coming out. So probably this all play out. It'll be an interesting time, I think.
Yeah. Okay, thanks, Dave. Anyone else? No, one of the other things I've been seeing in the news is just talking about like de-dollarization. So like I think China and Russia are kind of going after the dollar. I see like things with like Saudi Arabia and China and Russia and other countries like Brazil and things like that. So that could be something that would greatly destabilize US markets if people stop using the dollar a lot, because there's a lot of dollars out there. So that's just another kind of thing. I think it's at the beginning stages. So, but something to keep an eye on. And like we said, the Fed usually holds rates up there till they break something. So that's what the message I'm getting from Powell. They're not gonna do any rate cuts. That's their plan right now, unless something breaks, right? So I think that's what we go with as our base case here. They're just gonna maybe do one more hike and then just hold them till something falters. Okay. Anyone else I'll do a quick show you the earnings trades. Anyone else? Okay. There's virtual portfolio, just pull out. So here's all the trades. I just take snapshots. So we had one this morning, ConocoPhillips, a couple yesterday, HCA, Capital One Finance. These were estimated. JP Morgan, ABC, and then Exxon. And this PII, I think Chris talked about. We were on the call earlier. He talked about that one, but that was estimated, so I didn't do the trade. And then like Traveler, so quite a few estimated, and that's just kind of par for the course since COVID. So you can see we have 4 open trades, marginally down on 3 of them. HCI is up a little. We had 2 that closed out, XOM and ABC. So those hit their profit targets, rather quickly for both of those. So obviously good start. Nothing, especially with the market action last day or so, they're still looking good. Typically, we have these kind of, going up into earnings, and I talk about this a lot. Earnings season, it's like, okay, we put out the earnings plan here. We kind of down and then runs up. So put out the earnings plan here, and it kind of runs up right through the earnings. So we put out the earnings plan here, and it's been good so far. So we'll have to see how the earnings play out, as really it's their forward expectations and how those come out. But so far, nothing, looking pretty solid so far. But we'll obviously track it closely. Okay, that's all that came out, the bullish pre-runners so far. So any questions on that?
I do have a unrelated question. I know you've been showing the Excel file on the earnings plan results each quarter.
Yeah.
But there was also a file on the results of the daily trade ideas, and I haven't seen an update on that, and I'm wondering if you would have a chance to do that anytime.
Yeah, I was gonna I gotta redo that one, because what we wanted to, I gotta kind of reorganize it because the dates are a little wonky. We want it for like, I'll show you. So I'm in the process of doing that. So like you can see it's here through February. We want to go with January to January and like do it on like a normal quarterly basis. I just started this one like on in November and just started doing it every 3 months. So I'm gonna adjust it so it's like, from the start date, we're gonna do like year to date, so we'll end at the end of December. So it'll be like a normal quarterly, so we can have like year to date results. 2021 results, 2022 results. So I'm going through and updating those to reflect that. So it's a lot easier to understand.
Yeah, that's very interesting. When you get a chance to do it, I find it interesting.
Yeah. As soon as I get through it all, but you guys will be the first to know. So, good question. Okay. Anyone else for let Joe go? Okay. All right, Joe, you ready?
Okay, Josh. Good job as always. Thank you. Let's see. Let me grab this. Just a couple really quick things. I was thinking a little bit in terms of time. As you said, kind of a mixed bag here. We got the Russell still in 8. And from a timing perspective, we're about halfway through, 15 of 27 days typically, in state A for Russell. So we'll see whether a couple of weeks, we still have to the downside there. It's funny, you talked about, if we could hold that entry level price, which I guess was 1743. That's exactly what I thought in my notes as well. Just see whether we hold that. It looks like we did complete, a 5-wave, on the 24th of March, that last leg down. Clearly the Russell's been the weakest of the indexes. So, the 1743 will be interesting to see whether it holds the and it was really just a little bit of a run up, 124 points. So the retracements really, for the pullback kind of center around that 1743 level as well. So, we shall see. SPX, just, a little bit more of a run there. The SPX and the NASDAQ, bottomed a good week before NDX. And again, mixed bag, state 5, target 2's been met, but, target 2 is only, quick, like a 1.5% move. So not really a big deal. As you've said, those interim states oftentimes aren't quite as meaningful, but, we had a pretty good run off the bottom, 325 points, in the SPX. So you talked about that 40-50 level. Again, I think that was, the entry point. The retracements on the way back down are actually, well below that. So, range basically between 4,000 and 3,940, are the retracements coming out of this last 325 point run. So, day at a time overall, the markets still, seem to be holding up well. Last index wise, NDX, obviously has been the cream of the crop. And the one thing, to me in NDX, we'll see, it's been leadership since the beginning of the year. And from a timing perspective, on average, a state 1 runs darn near 40 days. We're only 5 days into it. So I think it's going to be who wins here. Is it going to be the current leadership with NDX, kind of lifting all boats, including Russell, over the next 4 or 5 weeks, or, is NDX going to, start to back off, see. But long way to go in terms of the average move in a state 1 for NDX. So I think an awful important index to keep an eye on. Under the surface a little bit, we've been trying to talk about the ETFs, and over the course of last week, we had a hell of a big move in the breadth of the ETFs. We had, when we did this last Tuesday, there were only 2 of the 11 ETFs in a bullish state. That has moved to 6. So a significant shift to, a more constructive move, at least from a state perspective. We've gone to 6 bullish, 5 bearish ETFs. I'll just pull up the charts quickly on a couple of them. XLF, as you'd expect, one of the state eights. We got that chart looks an awful lot like Russell. You had the first leg down, and then let's see here, 2 and 3 coming out of the downside. What do we got here? I'll do that another time. But basically, we got the 5 leg down, 1, 2, 3, 4, and then 5, very similar to Russell. And we're just kind of languishing along the bottom. The other one is, and again, really no surprise, would be XLF, the other state eight. So from a timing perspective, it has exceeded, its period of time, just kind of, dead in the water here, sort of as you'd expect, in the real estate market. Let me go back to, XLF from a timing perspective. We've got 12 of 30 days, so, we still got some time, from a bearish state in XLF. Let's see whether that holds true. I guess we're just going to slog along the bottom. The one, state one, not a surprise, we've talked about this before, is XLK, technology leading the charge. Very constructive chart. It's clearly been the leadership since October and certainly since the beginning of the year. So from a timing perspective, another 3 weeks there. So that kind of dovetails with NDX from a timing perspective. We'll see who wins. In terms of overall market news coming up, it's really a quiet week over the next week with 2 exceptions. Friday, we get non-farm payrolls expectations, 240, 250 range. In the last 2 months, that number's been all over the board, especially in January. So I think that certainly bears watching. And then we really, nothing real of anything significance coming out until next Wednesday when we'll get the CPI. So somewhat quiet from a news perspective. We're back into a trading range. I mean, we continue to be in the trading range, and I think more than anything, in the last couple of days, we probably got the short-term top, and now we'll just see how far the pullbacks are, and we go from there. You pointed out and mentioned the importance of the 10-year, the volatility in that bit is just unprecedented. Really important to keep an eye on that too. So not a whole lot, but that's what I want to touch on. Any comments or questions, please? And just one other thing I would mention is Josh and I were in New York last week. I think we had mentioned we're going to this academic conference. Josh, any comments? There have been 12 of these. It's a conference that's hosted by Quinnipiac University. The last 10 years, they've hosted it in Manhattan. First 2 years, it was on campus. There was a hiccup in 2020. They canceled it in 2020 because of COVID. The last 2 years, actually, it was via Zoom. But, Ashok was willing for Delphian to be a sponsor to this conference, which, before I offer my 2 cents, Josh, you want to offer your 2 cents on the experience last Thursday and Friday up in New York?
Yeah. So a really well done conference, class acts, good hotel, great program overall. I mean, they had a lot of kind of heavy hitters there. And I think the big thing was just, we interacted with a ton of students, and these kids are really sharp. I mean, I was very impressed with the caliber of kids that were there and the questions they were asking. I mean, the future is very bright, with kids that age. I was really impressed. So,
Is it just Quinnipiac students, or is it more than that?
No.
Go ahead, dude.
Sadir, this conference has grown over the years, and I've had the good fortune to participate in 11 of the 12. And even despite the cancellation in 20 and the last 2 years being via Zoom, it did not miss a beat. Neighborhood of 115 universities represented from around the country, Canada, and Even there was a school from Beirut that participated. About 1,100 students. I'm not sure whether it's 100 to 200 professors. And as Josh said, quite a heavy hitting group of speakers. They run 4 keynote panels on Thursday, and then on Friday they run concurrent breakout sections. That's where Shook, Josh, and I all participated on Friday. So, yeah, if you Google Quinnipiac Game Forum, you can see some of the details. It's really very nice of a Shook to support this, and it's as Josh said, I find it incredibly inspirational. Every year I've participated, I come away with the same thought that Josh has. We're in good hands. A lot of smart, eager, aggressive, students. Despite what you hear about, the next generation, there are a lot of hardworking, smart kids out there who want to learn more. And we're hoping in time we will, maybe create some option clubs at some of these schools. And also we're going to be offering some complimentary access to these students to get in there and, learn. I mean, the platform can be a great learning vehicle, but then also we'll get some fresh eyes and feedback, from, a different generation. So, yeah, that's where we were last week. So as Josh said,
is this a conference that like us individual investors would be worthwhile to go to?
Nope, it is strictly for university students.
Okay.
And their professors. So yeah, that's the pool, Sudhir.
Okay.
Was there a lot of discussions about artificial intelligence trading?
There was some actually. One, a couple of panels that I had the pleasure to moderate. We talked about it a little bit, and one of them, as you can imagine, that's right into a Shook's wheelhouse. He was partnered with a professor from University of Toronto. They have a trading lab up there that is sponsored by the Bank of Montreal. The trading lab's existed since 1999, and they were talking about the implementation of AI and its impact on both learning as well as research going forward. So yeah, plenty to talk about that, Russ.
I got a question for Joe. Going back to some of the sector kind of analysis that you were looking at. With regard to the NASDAQ really doesn't have any banks in it. That's one of the differential characteristics of the NASDAQ. And the Russell has all of regional banks in the Russell. So that I think just those two facts kind of support the NDX kind of like being on the rise from the beginning of the year, as I think the substantial group of market participants were thinking that the Fed was done raising rates, which raising rates, I think, and maybe your comments would be appreciated here. When rates rises, when interest rates rise, it has the biggest negative effect on the NASDAQ. And being that there's no regional banks in the NASDAQ, maybe that's why it went up from, it was a leading sector or group within the, overall, all the markets. Just any comments on that, Joe?
Yeah, and I think you bring up a good point, and maybe the perception of, rates not going up anymore certainly helped to drive it. But more than anything, Dave, I think the reason, the NASDAQ has been the leader, and it goes back to last October, that's when it bottomed. I mean, the NASDAQ index, is the only index that retraced well beyond the 618 retracement going back to the March 20 lows. So I think, part of the magnitude of the run in the leadership since October has been the depths of the fall over the previous year. And then on top of that, you take into account, this idea that, rates, at least the market, thinks that maybe increasing rates, despite what the Fed says, we've come to the end, is adding to the strength as well. But I think it was it was the magnitude of the fall and maybe the compression of multiples. At the same time, maybe somewhat less fear for significant drops in earnings as well. So as always, it's a pile of things, but number one, I would say the magnitude of the fall in the previous year.
Yeah, great points. Thanks.
All right, Josh?
Yeah, anyone else before we close up shop for the week? All right, well, we'll close it out here. Thank you all for attending. We'll do it again next week.
Thank you.
Thanks for joining, everybody.